The gap is no longer a rounding error, because right now the screen is whispering one price while the coin shop is shouting another, and the mechanism forcing that split is exactly what the mainstream keeps missing. So by the end of this, you'll know what level matters, what the market is quietly signaling through spreads, and what could snap into place as we roll through the next calendar window. Here's the uncomfortable truth. You can watch silver tick around the low hundreds on a futures quote, and then you can walk into a real shop and still feel like you are repaying a penalty just to touch the metal. And that penalty isn't random. It's not just greedy dealers. It's not just retail FOMO. It has a pricing system doing what it always does under stress. It starts charging you for time, for certainty, and for delivery. And that's where the real pressure starts, because COMEX and a coin shop are not pricing the same thing. They're related, but they're not the same thing. COMEX is pricing highly liquid exposure, fast, leveraged, and reversible. The coin shop is pricing a physical object that has to exist, has to be in stock, has to be fabricated into a specific form, has to be replaced when it sells, and has to be financed while volatility is trying to rip everyone's face off. When those two worlds diverge, it's not a conspiracy, it's a friction signal, and that signal is starting to matter. Let's ground this in what's happening right now, because context is everything. Gold has pushed above that psychological line everyone used to treat like science fiction, 5,000 an ounce. Silver has been flirting with triple digits, and depending on the quote and the moment, pressing above it. That alone should tell you something about the macro temperature. But the more interesting thing isn't the headline. The more interesting thing is what happens underneath the headline when price moves this fast. Liquidity thins, spreads widen, dealers get skittish, financing terms change, and physical supply chains, which are slow by design, start vetoing the fantasy that you can always convert paper into promoted metal at the same price. But that's not the part that matters. The part that matters is the gap itself, because a persistent gap is the market telling you. The marginal unit of demand is no longer purely financial. The marginal unit is reaching for something deliverable. And when that happens, the rules change, because deliverable supply is never as abundant as the screen makes it look. Not all inventory is for sale. Not all bars are in the right place. Not all bars are in the right form. And not all holders are willing sellers when volatility is this high. The next detail is what flips the whole setup. You need to understand what price discovery actually means in practice. Futures markets, like COMEX, are designed to discover price for a standardized contract with standardized delivery terms, and most of that trade is never intended to end in delivery. It's positioning, it's hedging, it's speculating, it's rolling. It's funds and dealers and producers and consumers doing balance sheet management in real time. That's not a critique. That's literally the design. The futures price is a phenomenal tool for speed, but speed comes with a trade-off. It's a price for exposure, not a price for a specific coin in your hand at a specific store at a specific moment. And when the world gets jumpy, the cost of bridging that difference rises, and that's where the gap is born. So why is it suddenly louder now? Because this is exactly the kind of tape that makes people stop trusting smooth narratives. When macro uncertainty spikes, rates, policy, geopolitics, currency, credibility, metals catch a bid. But when metals catch a bid this quickly, the paper lane can become a slip and slide. Leverage players get margin called, dealers widen spreads, liquidity providers step back, and suddenly the futures price can overshoot in both directions, violently, while the physical market moves in slow motion. That mismatch is not a bug. It's the system's way of rationing. And if you're watching for the next move, you need to watch how rationing happens, not just where the last trade printed. Because if this one level breaks, the math changes. Let's talk about the coin shop side without romanticizing it. A coin shop is not a charity, and it's not a prophecy machine. It's an inventory business. When a customer buys a tube of coins, the shop has to replace that tube. Replacement cost matters more than yesterday's spot. If spot is ripping higher and volatility is insane, the shop's risk is not the spot price on a chart. The shop's risk is, can I restock tomorrow at what price, with what shipping cost, with what delay, and with what wholesale availability? When that's uncertain, premiums rise. They rise because uncertainty is a cost. They rise because inventory is a balance sheet. They rise because the dealer has to survive the whipsaw. But here's the key. Premiums done always fall back down just because spot falls for an afternoon. Physical markets have memory. They reprice slower. And that lag is one of your best tells. Now, the easy version of this story is physical tightness is real. That's a fine bumper sticker, but it's not enough to trade your brain with. We need mechanisms. We need proof stacks. We need to know what forces participants to do what they do. So here's the hidden detail that reframes everything. The spread between paper and physical linkage is where stress shows up first, and that spread can change the direction of price discovery even if the headline price looks calm. In other words, the price might look like it's telling the truth, but the spread is the one confessing. And that's where the real pressure starts. Think about how the bridge works. Big players don't usually buy from a coin shop. They operate in wholesale channels, in bars and contracts and allocations. There are mechanisms that connect futures prices to physical prices through arbitrage. Buy here, sell there, deliver this, finance that. When everything is smooth, arbitrage keeps prices aligned. When frictions rise, financing costs, shipping constraints, fabrication bottlenecks, risk limits, arbitrage becomes less aggressive and the alignment loosens. This is the part people miss. They assume prices must match because markets are efficient. Markets are efficient until they're expensive, and right now, the bridge is getting expensive. Let's get concrete. Futures are a promise with rules. Physical is an object with logistics. A futures contract has delivery terms, but the deliverable supply is not the same as total supply. And even inside warehouses, you have categories that matter. Some inventory is eligible, meaning it meets specifications and can sit there. Some is registered, meaning it's actually available to satisfy delivery against a contract. That difference sounds like paperwork until you realize one category is basically could be deliverable, and the other is deliverable right now. And when people start caring about delivery, that distinction stops being a footnote and becomes a signal flare. But that's not the part that matters. The part that matters is what happens when deliverable supply feels tight relative to demand urgency. The market doesn't necessarily run out of metal. That's a dramatic headline people love. What happens instead is subtler and more powerful. The market starts charging you for immediacy. It shows up in nearby contracts, trading stronger than later contracts. It shows up in backwardation, where the curve is essentially saying, I'll pay you more to give it to me sooner. It shows up in spot premiums. It shows up in the way dips get bought faster and bounces get sold less. And once you see that, you can't unsee it. Term structure is your lie detector test. In a normal, well-supplied market, the curve often sits in contango, later months slightly higher. Because of carry costs, storage, insurance, financing. When the curve inverts, nearby higher than later, something has to be true. Either immediate demand is urgent or immediate supply is constrained, or both. And crucially, an inverted curve changes behavior. It punishes holders for waiting. It rewards those who can deliver now. It can pull material out of private hands. It can change hedging flows. And it can create reflexive moves because traders stop viewing the market as safe to short and roll forever. The next detail is what flips the whole setup. Now layer in the calendar. This is the why now trigger that people always underestimate. Markets don't move in a smooth line. They move around deadlines, options expiry, month end, quarter end, delivery windows, reporting dates, roll periods. These are not vibes. These are forced actions. When a big options expiry hits, dealers who sold those options have hedges that change with price. That's delta hedging. And when you get close to certain strikes, the hedging can become nonlinear. That's gamma. In plain English, sometimes the market is not being moved by opinions. Sometimes it's being moved by risk management math that forces buying or selling as price moves. And if you're only watching headlines, you'll miss the mechanical shove. Because if this one level breaks, the math changes. Let me make that simple without dumbing it down. Imagine a pile of call options sitting at a big round number in silver. As silver rises toward that number, dealers who are short those calls might have to buy futures to stay hedged. Their buying pushes price up. That pushes the hedge requirement up. That can create a feedback loop. Not always, not guaranteed. But in thin liquidity, it can matter a lot. Now flip it. If price drops away from those strikes, hedges can unwind, accelerating the drop. That's why you can get violent two-way action even in a bullish regime. It's not the market changed its mind. It's hedges changing shape. And that's where people get emotionally ambushed. Now add margin. This is the trapdoor under the paper market that physical buyers rarely appreciate until it slams shut. Futures are leveraged. Leverage is beautiful until volatility spikes. When volatility spikes, exchanges can raise margin requirements. That means traders need more cash to hold the same position. If they don't have it, they sell. If enough of them sell at once, price drops fast. That drop triggers more margin stress. That triggers more selling. You can get a waterfall that has nothing to do with long-term fundamentals. It's a liquidity event. And here's the punchline. During a paper liquidation, physical premiums often stay stubborn because physical dealers are not getting a magical discount from the wholesale chain in real time. Their replacement cost uncertainty can actually rise when paper crashes because they don't trust the crash to stick. So they don't lower premiums as fast. The price gap can widen right when your intuition expects it to shrink. But that's not the part that matters. The part that matters is what the gap is telling you about the underlying bid. If paper gets hit and physical stays firm, that's a signal that the selling is financial, not fundamental. If paper rips and physical premiums explode, that is a signal that the move is pulling in urgent real demand that the pipeline can at T satisfy quickly. Either way, the gap becomes a diagnostic tool. And right now, the diagnostic is flashing. So let's build the proof stack like adults, not one argument, 5 layers. Minimum. Layer 1, the headline price regime. Gold above 5,000, silver around or above 100 is not normal carry trade behavior. That's a safety bid, plus a confidence signal that something in macro is unstable, not apocalypse. Instability, the kind that makes investors pay up for insurance. Layer 2, the curve. Watch whether nearby contracts stay rich relative to later months. If the curve stays tight or inverted, that's the market paying for immediacy. If it normalizes quickly, that suggests the stress is easing. Layer 3, inventory categories. It's not just how many ounces exist in warehouses. It is COMEX. How many ounces are positioned to satisfy delivery versus sitting in the system but not offered? If registered supply trends down while interest in delivery rises, that's a squeeze ingredient. If eligible rises but registered doesn't, that can mean metal is present but not for sale at current terms. That distinction matters. Layer 4, spreads and linkage. Watch paper to physical linkage pressures, how expensive it is to move from futures to physical channels. When that linkage is strained, price discovery can drift. That's when the coin shop price becomes a separate truth. Layer 5, on the ground symptoms, premiums, availability, delivery times, wholesale backlogs. The stuff people dismiss because it's anecdotal is often the earliest sign that the pipeline is constrained. If you can't get standard products easily without paying up, that's a symptom, not a guarantee of higher spot tomorrow, a symptom of friction. And I'll add a 6th layer because this market deserves it, cross-asset behavior. Watch the dollar, real rates, credit spreads, and risk appetite. If metals are rising while the dollar is firm and real yields aren't collapsing, that's telling you this isn't a simple rates down, gold up story. It's a confidence and hedging story. That's a different engine. And the next detail is what flips the whole setup. Now, let's address the skeptic in the room because we need trust more than hype. The skeptic says, retail premiums always do weird things. Coin shops are noisy. COMEX is the real price. Sometimes that's true. Sometimes the physical premium is just a temporary bottleneck. Mints get back online, wholesale inventories refill, spreads calm down, and the gap compresses without drama. That can happen. In fact, it often happens. So the existence of a gap doesn't automatically mean moonshot. It means you should stop treating the screen price as the whole story. It means you should watch whether the gap is widening, persistent, and broad-based across products and regions. That's the difference between noise and signal. Here are the clean ways the gap can shrink fast without some Hollywood squeeze. 1. Volatility cools down. When volatility falls, dealers are willing to run tighter spreads and lower premiums because their inventory risk drops. 2. Supply chain catches up, fabrication and distribution normalize, and popular products get replenished. 3. Demand shifts from I need it now to I can wait, which reduces urgency pricing. 4. Paper price consolidates instead of ripping, giving wholesale channels time to reprice inventory. Any of these can compress the premium. That's why you don't treat the premium as a prophecy. You treat it as a thermometer. But now let us talk about why this could still matter a lot in the next week or two. Because the calendar doesn't care about your feelings. If we're moving through an options expiry window or roll period or month end, you can get forced positioning shifts. Funds that benchmark month-end levels care about closes. Dealers care about where options pin. Hedgers care about where they can lock margin. And when price is sitting near a psychologically loaded number, like silver hovering around triple digits, those forces intensify. The market becomes a chessboard where pieces have to move, not because players want to, but because the rules of the game force them. And that's where the real pressure starts. Let's put a spotlight on one underappreciated piece of psychology. Round numbers create fake certainty. People anchor to them. They think, if it breaks 100, it's over, or if it loses 100, it's done. Markets love to weaponize that. They will whip above it, whip below it, and punish anyone whose plan is literally just a number and a vibe. This is why you need a viewer psychology shield, and you need it now. Here's how volatility manipulates you. First, it gives you a clean story. Then it rips in your direction so fast you feel like a genius. Then it drops hard and makes you feel stupid. Then it bounces and makes you chase. Then it dumps again and makes you swear off the whole thing. That's the cycle. It's not an accident. It's how leveraged markets transfer conviction from the impatient to the prepared. And the solution isn't never trade. The solution is pre-commitment and scenario thinking. You need to separate trend signal from noise. Trend signal is structural. Persistent strength in nearby contracts, repeated dip buying, sustained premium behavior, tightening deliverable supply, macro conditions that keep safety bids alive. Noise is the violent two-day move caused by margin, option hedges, or a headline that disappears by Friday. Both can happen at the same time. That's why smart people get chopped up. They confuse noise with invalidation. But that's not the part that matters. What matters is having a 2-scenario lens, so you're not emotionally hostage to the next candle. Scenario 1, controlled pullback and retest. In this scenario, silver doesn't just rocket in a straight line. It pulls back, shakes out late longs, tests a prior breakout zone, and then stabilizes. Premiums may stay sticky even as spot cools. The curve may stay firm. That would be a bullish stabilization, not a failure. Confirmation would look like dips that find support quickly, spreads that stay tight, and physical pricing that doesn't collapse. Scenario 2, continuation squeeze and gap risk. In this scenario, price doesn't give you a polite pullback. It keeps grinding higher, and when it runs into heavy options, strikes, or thin liquidity zones, it gaps. Short hedges get forced. Dealer hedges chase. Anyone who was waiting for a better entry gets priced out emotionally. Confirmation would look like acceleration through key levels with strong closes, persistent backwardation or tight front spreads, and physical premiums that expand rather than compress. And here's the credibility piece. Both scenarios can be bullish over a longer window, and both scenarios can still include brutal downswings. Price can whip around violently, even if the thesis is correct. That's not a disclaimer. That's reality. Metals don't trend, they lunge. And if you treat every lunge as a verdict, you'll never hold a coherent plan long enough for structure to matter. The next detail is what flips the whole setup. Now, let's get practical. What should you watch next week? Not 10 indicators, not 50. A tight checklist that reflects real mechanics. Watch the nearby versus later structure in silver. If nearby stays rich, urgency is still present. If it relaxes fast, stress is easing. Watch the behavior around the big round number zone. Does price reclaim it quickly after dips, or does it chop and stall? The way it behaves around that psychological shelf tells you whether dips are being used to accumulate or to escape. Watch physical availability and premium behavior. If spot drops and premiums don't, that's a sign the physical market isn't convinced the drop is real. If spot rises and premiums explode, that's a sign the pipeline is being stress tested. Watch volatility and margin chatter. If volatility spikes and the paper market sells off hard, ask yourself whether physical follows or resists. That divergence is information. Watch gold alongside silver. If gold holds firm above major psychological zones while silver whips, silver might be the leveraged expression of the same macro bid. More volatile, more reflexive, more punishing, but also more sensitive to positioning. And finally, watch the narrative whiplash, because it's part of the trade. When metals rise, you'll hear safe haven. When metals fall, you'll hear bubble popped. The headlines are not analysis. They're emotional permission slips. The market uses them to move your hands. Don't let it. Now, let's talk about the institutional angle, without turning it into a cartoon villain story. Institutions don't wake up plotting to suppress your coin stack. They manage risk, they manage balance sheets, they manage liquidity. And when a market becomes volatile, the first thing institutions do is protect themselves. That means widening spreads. That means reducing inventory. That means tightening financing. That means fewer players willing to provide liquidity at tight terms. And when fewer players provide liquidity, prices can gap and dislocate more easily. This is why the gap between COMEX and the coin shop can become meaningful. It's not a moral story, it's an incentive story. If you're a dealer or a wholesaler, you're not thinking, what's the spot? You're thinking, what's my risk if spot moves 5% overnight and my supplier reprices before my customer does? If you're a fund, you're thinking, what's my risk if margins increase and liquidity disappears? If you're an industrial buyer, you're thinking, can I secure supply without getting squeezed by delivery delays? Different players, different constraints, same market. And when constraints tighten, the bridge price changes, and that's where the real pressure starts. Let ES address one more misconception that will save you a lot of pain: the idea that physical premiums must collapse when spot rises because supply will come out. Sometimes supply does come out, but metals are not like soybeans. You don't just plant more silver next quarter because price is high. Silver supply is often tied to byproduct production from other metals. Mining lead times are long. Refining capacity is not instantly elastic. Recycling responds, but it responds with a lag. And fabrication capacity, turning raw metal into the specific coins and bars people actually buy, can become a bottleneck even when raw metal exists somewhere in the system. This is why high prices cure high prices is slower here, not impossible, slower. That slowness is exactly what can keep the physical market sticky while the paper market freaks out. Now, does that mean you should assume the gap will widen forever? No. Markets resolve. They always do. The gap can close by spot rising to meet physical. The gap can close by physical easing while spot consolidates. The gap can close by spot dropping hard while physical finally caves. The key is, you don't guess. You observe. You watch the mechanics. You let the market tell you which resolution it's choosing. But you can only hear the market if you stop staring at one number and start watching the structure around it. So here's the cleanest way to think about it. COMEX tells you where liquidity is. Coin shops tell you where scarcity is. When liquidity and scarcity disagree, you don't pick a side emotionally. You ask, what's changing that makes them disagree? And right now, the answer looks like a mix of macro hedging demand, thin liquidity around a major psychological zone, elevated volatility that punishes leverage, and a physical pipeline that can instantly supply the exact products people want at yesterday's terms. That combination is exactly how two price worlds are born. And if you're the kind of investor who's skeptical of institutions, good. Keep that skepticism. Just aim it properly. Be skeptical of simple stories. Be skeptical of anyone who tells you price is guaranteed. Be skeptical of anyone who ignores curve structure, ignores inventory categories, ignores options, reflexivity, ignores margin dynamics, and then pretends their chart line is destiny. The market is a machine. Learn the machine and you stop being a passenger. Now I'll give you the most actionable takeaway, the one metric that is quietly more important than the headline price. Watch whether the market keeps paying for immediacy. That can show up in tight front spreads. It can show up in persistent premiums. It can show up in fast dip buying. It can show up in delivery interest. Because when a market keeps paying for immediacy, it's not just bullish. It's stressed. And stressed markets don't move politely. They move with gaps, shakeouts, and sudden repricings that make yesterday's fair value look like a joke. But that's not the part that matters. What matters is being prepared for how it tries to trick you. If you're bullish, the market will punish you with a violent pullback right after you get confident. If you're bearish, it will punish you with a squeeze right after you get comfortable. The only defense is a plan that survives both. A plan that respects volatility, a plan that distinguishes structural signals from noise, a plan that doesn't require you to be right every day to be right over a cycle. So here's the near-term roadmap, clean and simple. If silver holds the psychological shelf it's fighting around, and the curve stays tight and physical premium stays stubborn, that's the controlled strength setup. Expect pullbacks, but treat them as tests, not verdicts, until structure breaks. If silver accelerates through that shelf and starts closing strong while premiums widen and immediacy pricing persists, that's the continuation squeeze setup. And you should assume gap risk both ways, meaning it can rip up and it can slam down, sometimes in the same week. If, on the other hand, the curve relaxes, premiums compress quickly, and price fails to reclaim key levels after a retest, that's your weakening signal. Not the end of metals forever, a regime shift in the short-term pressure. And yes, this is the part where people want a clean number. The truth is, the exact number matters less than the behavior around the number. Watch how price reacts when it drops. Watch whether buyers show up quickly or hesitate. Watch whether sellers can push it down and keep it down. Watch whether physical follows the drop or resists it. Because the market's reaction function is the real chart. If you're still here, you were the kind of person I'm building this for. Someone who rather understand the mechanism than chant a slogan. That's the whole point. This isn't about trust me. It's about teaching you what to watch so you can trust the process. And if you want to stay in a community that watches structure instead of headlines, you already know what to do. Keep showing up, keep comparing the paper lane to the physical lane, and keep your plan intact when the market tries to rent space in your nervous system. Because the price gap is starting to matter, not because it guarantees anything, because it's a live read on stress. And stress is where the biggest moves are born and where the biggest mistakes get made. Stay mechanical, stay patient, and watch whether the market keeps paying for immediacy, because if it does, the next week or two could get a lot louder than most people are ready for.